Half of all adults have more credit card debt than savings, 25% have no savings at all, and only 15% of the population is on track to fund even 1 year of retirement. My name's Jacob Voles, and let's talk about retirement. What is it? It's when you get to stop doing your career and do something else instead. That means you need some money so you don't die poor on the riverbanks of Mustafar, and that means you need to save some. Social Security is running out of money, and millennials are too focused on other aspects of their financial being, such as increasing their credit score, paying off student loans, not operating on a budget, and investing in avocado toast to save for retirement. Even when employees are given the option to invest through an employer retirement plan like a 401k, they don't. Employees often not only allow for the tax benefits from a 401k, but will also match up to a limit your contribution into your own retirement fund. Not signing up for that is like turning down free money. Wait, Jacob, I thought you said that retirement was for after your career. Why do we need to worry about this right now? That's like a long time from now. Well, I'm glad you asked that because time plays a huge factor in this equation. Time is super important in the stock market. Every day the stocks go up and down. Sell, 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 buy, buy, buy. If you're looking in the short run, you might not even find a trend, just some red and green. But in the long run, the value of a portfolio of stocks and bonds grows. Think about it this way. We can see trends in the weather and climate change mapped over the years, but it's impossible to guarantee with 100% accuracy that it will rain tomorrow. It's the same thing with investments. If you buy and hold investments over the course of 40 to 50 years, even huge events like the Great Depression and subprime mortgage crisis look like momentary anomalies in one long upward trend. Yay! So consistency in the long run is an important reason to start early, but it's also important to note that different types of investments have different returns and different volatility levels. Some investment strategies focus on small stocks, which can be high risk, high reward. When you're a young whippersnapper, you can invest in these risky portfolios because if you lose a ton of money, then don't worry about it. You've got time to rebuild. And if you gain a lot of money, then congrats. You're a genius investor. As you get closer to retirement, you can't afford to lose your nest egg, so you should start to move your investments into safer stocks and bonds. That way there isn't much upside or reward, but the risk of losing your money is low. This graph I showed just a moment ago tracks the value of a $1 investment in different asset classes over 100 years. Although it's a pretty bumpy roller coaster, the return on those risky small stocks is so much higher over time than the slow and steady T-bills down here. So, if you start early, you can benefit from higher risk, higher expected return portfolios and still see long-term growth. However, perhaps the most important part of starting saving early is that you get the huge advantage of returns on your returns. Let's take a look at some concrete numbers to see what that means. Let's say you're planning on investing $3,000 in an account earning 12% per year for retirement. If you put it at age 23 and withdraw it 50 years later, how much will you have? $867,006.57. If you wait 10 years so it stays in the account for only 40 years, how much will you have at the end? $279,152.91. Those numbers can't be right. That's like a huge difference there, says Jesse from Starbucks. Yes, Jesse from Starbucks, those numbers can be right. And they are. Time plays such a big factor because the initial investment is only making $360 a year. That interest is up here in orange. But the gray grows every year because it's adding 12% onto the growth that it's already experienced. This is 20 years, but what happens if we do 50? All of a sudden that $3,000 seems pretty insignificant. All you can see is gray. The time is what matters because the real money comes from the interest on interest. So with math on our side, I think we can agree that earlier is better. So why isn't everybody jumping on this as soon as possible? Here are Jacob's 8 reasons people don't save for retirement, and why they're wrong. Reason 1. Saving for retirement is complicated. Financial advisors use a lot of lingo. For example, with the potential that the Fed might raise interest rates this year, bond coupon rates are increasing and thus the attractiveness of stocks is decreasing. With an increase of inflation in the future, the stock market could be nearing the end of its bullish market. What companies should I invest in? Quick side rant because this is really important. Please, for the love of God, don't invest in individual companies. 1, don't put all your eggs in one basket. Companies can go out of business, so if you're only invested in a few stocks and they die, bye-bye money. Systematic risk like recessions are unavoidable, but non-systematic risk can be eliminated if you diversify. When you spread out your money into 500 plus stocks, it lowers the risk without sacrificing any return. Take a look at these returns. All these guys down here are the individual stocks. These boxes up here are portfolios made up of a bunch of different stocks. Do this one. If you buy individual stocks instead of mutual funds, that's your own stupid fault. I'll get to mutual funds in just one sec. Anyway, back to the financial jargon. We've got 401ks versus 403bs, IRAs versus Roth IRAs, large cap growth versus large cap value. Too much lingo! Financial managers are making a living by taking simple concepts and making them sound complex. And yeah, knowing that kind of stuff can be useful in the long run, but a lot of these choices people obsess about, like what to invest in, just aren't relevant. The problem isn't annual returns. In our $3,000 example above, if we change our 12% to a slightly worse investment at 11%, it doesn't matter as much as the timing of getting started does. For the time being, put the money in a target date mutual fund. That's an investment where you just select which year you want to retire in and let somebody else manage when to adjust your risk to return ratio. Let someone else start with the small risky stocks and move your money into bonds when you need to start stabilizing your returns. When you get hundreds of thousands of dollars in there, then it might be time to start getting some professional advice, but putting it anywhere is better than nowhere. If you're a nerd like me, you can go ahead and do research on the individual options, but it doesn't have to be that hard. Reason 2. I don't know how to set it up. This one actually has a little bit of merit to it. Oftentimes investing websites are hard to navigate and confusing. They may look a little bit like this. Just kidding, that's a fighter jet dashboard. Investment sites often have phone apps that look like this. Look at how polite it is. It's pretty easy to get started. Reason 3, I want my money now. You just got out of college, you're making some good money for the first time in your life, and you want to live a little. Finally, you can afford to lease that new sports car, rent in the nicer part of town, and upgrade from ramen to spaghetti tacos. Those in the FIRE, Financial Independence Retire Early movement, would say, eat more ramen, drive that $1,000 car, and put all the cash away. You won't notice it, just keep on living the same way you're used to and you'll be able to retire early and do whatever you want. You don't need to go to that extreme, but our societal norm is indebtedness and living beyond our means, with 76% of Americans living paycheck to paycheck. Being normal will put you in a place where financial peace is impossible. So, strike a balance. Let's go through a quick scenario. Let's say you take 15% of your income out of your paycheck, that's generally recommended, put that money in a Roth IRA, that means you pay taxes when you put the money in, but it grows tax-free, and get yourself on an intentional budget. If you tell your money what to do, you'll feel like you got a raise. And let's say you avoid debt. Let's start with the starting median salary of a UW graduate, $52,400. And let's say you never get a raise, which would not happen. Let's assume you're getting an average return of 10% from graduation at age 22 to retirement at age 65, and you have no money saved when you graduate. Plugging that into a $30 calculator, we'll see that you'd retire with $4.7 million. Is that worth a little bit of self-restraint? It is for me. Reason 4, my startup doesn't give me cool retirement benefits like this. Well, you are out of luck. You're pretty much done for. Psych, free money is cool, but you don't need a 401k match to invest. You can go set up an IRA or Roth IRA with an investment firm like Vanguard or Fidelity, or even at a bank. Reason 5, I started to set it up, but I forgot my password. Right. Reason 6, investing is selfish. I don't want to feed the evil bankers and tycoons of capitalism. Having more money as a result of sound financial decision-making actually opens you up to be more generous and give back to causes that inspire you. More money equals more freedom and more leverage to make the world a better place for you or others. Don't like evil rich people? Be a good one. Reason 7, it's too late to start saving for retirement. No, it's not. You might have less time to figure things out than if you started earlier in life, so you've got your work cut out for you, but the worst thing you can do is continue to stick your head in the sand and put it off. Reason 8, the government will take care of me. I mentioned earlier, Social Security is quickly running out of money, and you don't want to live the kind of lifestyle that Social Security provides you anyway. You deserve better than that. Retirement should enable you to do what you want. Okay, so that's 8 reasons, so let's bring this around and talk about how we fix the problem. How do we get people to plan ahead and take advantage of resources when they're handed to them? For you individually, redefine retirement in your mind. Retirement isn't the same as retirement home. You don't have to save to retire as some guy who sits on his porch drinking sweet tea. Set a goal for yourself. Imagine what you would do if you won the lottery, set that as your goal, and then choose to win the lottery. Save money and retire on your own terms. Travel the world. Start your own business doing what you love. Spend your time learning an instrument and playing in a band. Buy a mega yacht with a helicopter pad. If we don't set goals, we'll never hit them. On a larger scale, there's a concept called nudge paternalism, which may lend a solution. When a company sets defaults for retirement plans, these have been shown to have an enormous impact on employees' participation, contribution, and asset allocation. When enrolled into a retirement plan by default, very few employees choose to opt out, and most don't even change the contribution rate or asset allocation from the defaults. One problem here is that employees are delaying thinking about or being intentional with their finances, but at least they're getting on top of that time value of money. Whatever your excuse, stop having that excuse, and save for retirement instead.